All right, here's why you need to own some bonds. And if that bothers you because I said a few years ago, don't own bonds, well, I'm changing my mind. Situation dictates, my friends, and if you can't change your mind as the situation changes, I don't know what to tell you. I've never, in fact, when it comes to politics, I've never understood people say, well, 10 years ago, you used to be for gun control. Now you're not. You're not. I've never understood that stuff. People change their mind all the time. It's not necessarily a bad thing. Now, if people are squishes and they don't make a solid argument, then I don't like that. But it's okay to change your mind. All right, so let's take a look here, my friends. First and foremost, what is the 10-year Treasury doing right now? Oh, lo and behold, the 10-year Treasury is at one. Well, I had it right there. Where'd it go? 1.29. The 10-year Treasury is yielding less than 1.3%, which is off some 45 basis points from where it was at the high. So basically, that was it was yielding 1.73 on March 15th. So now it's a 1.2. We'll just say for simplicity, for my hard head here, 1.73 minus 1.29. It's down 45 basis points from its high with 4 months ago. March is 4 months ago. Divide by, that's down 25%. So the interest rates have gone down 25% in 3 months. That's impossible because the economy is inflationary, is it? And let's look at it. Now, I tell you, everyone's saying because the feds are buying up all these bonds. Look, I've read so many articles on this today. I say, what is causing this? No one is saying that. Doesn't mean it's not true. It just, if that was so obvious, then why wouldn't people at Schwab, people at UBS, people at all these investment shops be saying that? And no one is, which should tell you something. All right, so let's look at the 30-year. The 30-year is at 1.93, which is off. It's 1.93 at 2.41. 30 years off 50 basis points, off 2.4. That's off another 21%. So in 3 months, interest rates have dropped 25%. That's freaking nuts, man. That's not a huge inflationary economy. So let's just look at Japan. As I always go back to Japan, and I'm using my man Daniel Kuhlbert's spreadsheets here at 55e.co. Look, if you don't like spreadsheets, don't worry about it. I love spreadsheets. Oh, by the way, every socialist is a disguised dictator. Let me just make this bigger, actually. Don't forget, every socialist is a disguised dictator. So if you're a socialist, get out of here. All right, so we're going to start with a 10-year bond. All right, we're going to start with a 10-year bond, and we're going to see what happened in the Nikkei. And this is just starting in 2000. And then we're going to start with the Japanese 10-year bond. And then we're going to start with the $100,000 in the Nikkei. So let's take a gander, shall we? And what we'll see here is $100,000 in the Nikkei, in the Japanese 10-year bond. After 10 years, if we go to 2009, it was worth $114,000. $100,000 in the Nikkei after 10 years was worth $55,000. Yeah, that's freaking ugly, but ugly, as we like to say. This is U.S. What inflation rate is that? That's a U.S. inflation, by the way. All right, so we go to the 10-year Treasury. After 20 years was worth 121. So we made 20% on our money over those 20 years in the Japanese bond market, but we didn't lose anything. All right. Now notice, what did the Nikkei do? It went back up to 144, but look, it was down as low as $44,000 in 2000. What was that? 2011. It was down as low as $44,000. So the Japanese stock market has been on a tear since 2011. Look at that. 22, 56, 7, 9, nothing, 19, negative, 18, 16. Interesting. So the Japanese market has tripled. Yeah, tripled, roughly, a little bit less than tripled in the last 10 years. Pretty good, huh? But what happened in the previous 10 years? Oh, the Japanese bond market, the Japanese Nikkei got killed. Look at that, man. It was down. I mean, $100,000 invested in Nikkei was worth $46,000. And 9 years later, $44,000 12 years later. That's freaking insane. $10,000, $100,000 invested in the bond market was still worth more than what you put in. All right. Let's make this even uglier. We're going to take $5,000 a year out adjusted for inflation. I don't want to adjust for inflation because that's the American inflation. We'll say fixed. Take $5,000 a year out fixed. They're doing it differently. Let's just do like that. 5,000 year out for the bond market, fixed starting in 2000. All right, the bond market, 5,000 year fixed. By the time 2020 rolled around, we had $8,000. So it lasted 20 years. The reason we're not adjusting for inflation, because I don't have the inflation data here for Japan. I don't think. Let me double check. I don't think we do. Yeah, it just says inflation adjusted right there, and I don't. We don't have the inflation numbers for Japan. But anyway, you can still see it doesn't matter because there's going into deflation anyway, and you can tell that by looking at the bond yields. 1.1, 0.1, 0.1, 0.3, 0.6, 0.8 negative. Crazy, man. All right, so now let's do that with the Nikkei and see what $5,000 adjusted for inflation, not adjusted for inflation, did in the Nikkei, which is the Japanese stock market, by the way. You ran out of money right here, 2012. Yeah, good times. All right, so that's not where the fun ends. Let's go back to 2000 and 1990, shall we? And we're same thing. We're going to take 5,000 a year. We're not even going to adjust it for inflation. Thus, if you're one of these guys saying inflation is always and everywhere a monetary thing, too much government spending is going to be inflationary, then it's going to be even worse than what I'm showing you. And then Nikkei, if you start in 1990, your $100,000 lasted until you were right there, 1999. $100,000 lasted until 1999. Taking 5,000 a year out. All right, so let's go to let's zero that out. We'll go to the bond market. And again, 100,000 is not adjusted. 5,000 a year is not adjusted for inflation. If you were adjusted for inflation, it probably wouldn't be that much worse because there wasn't much inflation. But on the front end, there was a little bit of inflation. And you can see by the 6% yield on the bond. $100,000 ran out of money when? Right here, 2020. So your $100,000 ran out of money in 2020 in bonds if you started in 1990, which is 30 years later, man. It's the worst market. I mean, look at this. Look at this stock market. I mean, look at that. Look at that. And people say, yeah, but the interest rates are going down. The bonds were going up. Were they? 0.8, 1.3, 1.3, 1.6, 1.7, 1.4, 1.3, 0.3, 0.6. I mean, the interest rates were not, you aren't making any interest, man. Hey. So anyway, let's do this. Let's do, we'll do, how we want it. Let's do 50-50. 50,000 in the bonds and 50,000 in Nikkei. Started in 1990. Let's see how long this lasted for. Withdrawal. Okay, good. And it should take it. So they're going to take it from the bonds if we have a down market. This is why this spreadsheet is so fantastic, because Dan's programmed it to take it from the bucket one if there's a down market in bucket two. So the problem here is bucket two ran out of money right there. In 2003, it still lasted 13 years. And bucket one ran out of money in 2000. Was that 17? 2008, excuse me. So it still lasted 18 years. And I mean, that just, look how bad that was. Look how bad. So the stocks destroyed you, man. It destroyed you. All right, so let's start in 2000 instead, shall we? And presume we missed those first 10 years. All right, so in 2000, we're going to do the same thing. We got 100,000 each. And bucket one, bucket two, the stocks ran out of money in 2000 and, what was I going to say, 11. 2012, and you ran out of money in 2016 if you're taking 5,000 a year, not adjusted for inflation. But again, if we just had nothing but the bonds in there, we're going to put zero, $100,000. You had nothing but bonds in there. Your money lasted until 2020 if you fixed it, all right, if you had nothing but bonds. If you started in 2000, if you started in 1990, it lasted until 2020. I mean, look at that, man, because you had better returns on the front end. However, I don't expect that. We're not getting that at 10-year Treasury. 10-year Treasury is paying just a little bit south of this right here. So I would be more expecting to get the 2000 scenario where you rent out in 20 years as opposed to the 1990 scenario, because you're not getting 6.5%. You're only getting 1.25. Man, that's why you got some bonds, man, because you just don't know. Now we can make an argument. All right, let's start in 1980, Josh. And I just find this argument to be a little bit facetious. Oh, we can't go back to 1980. Huh. I wonder if that's because of bonds. Let's go 0 here. We'll go to $100,000 there. Yeah, we should be able to go back to 1980 with Nikkei. Huh. Interesting. I wonder why it doesn't. Anyway. Oh, wait. Oh, here we go. Oh, sweet. There we go. 1990. Yeah, you still let's go back to 1980. I'm doing something wrong. What am I doing wrong? I gotta change this around. Maybe we'll do this at 1989. I don't know. It used to let us go back. But anyway, either as it may, I don't even. The positive returns are not what I'm trying to show you because that's already happened. That's already happened. We're already in the back end of positive returns. I don't know when the back end is going to hit. And I was listening by a lady who I follow quite a bit today, Prepper Princess, and I was like, oh, and I like Prepper Princess. She started talking about the stock market, how it always goes up when it goes down. And I hate that because it doesn't always go up. I mean, just again, look, if we started with nothing but $100,000 in the Nikkei in 1990, and we're not going to take anything out. All right, I just want to show you, man. It doesn't always go up. We're not taking anything out. We start with $100,000. We are right now at. Hang on a second. We gotta go back to. Oh, there we go. Oh, I gotta start. Okay, I gotta go back to 2020. There we go. All right. So we're going to start here. So we start in Nikkei in 1990. We are sitting at, where's 2020? We'll just go down here, right there. We are sitting at right now $70,000. $70,000. That's with 100,000 in 1990. That's without touching any money. Without touching anything, we're sitting at $70,000. In 2011, we're at $21,000 without touching it. So yeah, it's gone up. It's gone up 3.5 times since 2011, 3 times or so. Yeah, I guess about 3. But that's not up just because it fell and went up. It's still not even back to where you were break even. That's after 30 years, man. After 20 years, it's still only worth 144. Anyway, be careful for people who say it always goes up. They show you these charts over 100 years. It always goes up. I'm like, oh, stop! Don't do that. It bothers me when people say this. I'm like, yeah, and the U.S. was exceptional and will be exceptional going forward. I don't know, but I'm certainly not risking it all on that. So anyway, not trying to bash the Prepper Princess. I like her. I was like, oh, that bothers me. It always goes up. And if you're getting ready to retire, hell's no, man. You pull money out. You can't afford it. That's why you need bonds. All right, love to hear your thoughts. We'll see you.